Imagine waking up one morning, checking your bank account and finding it empty. Not because someone hacked it, not because you forgot to pay a bill, but because the entire system you trusted, banks, governments, markets, was crumbling under its own weight. It was September 15th, 2008. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. And suddenly, the world realized something terrifying. The global economy could actually fail. A few days earlier, no one imagined this, and yet the collapse was inevitable. But why? That's the story few people really understand. You might think 2008, that was years ago. But here's the catch. Most of the same mechanisms that almost sank the world economy are still in play. The same types of loans, the same financial bets, the same math. And understanding what happened isn't just history, it's a warning. Because the truth is, the system is fragile. Very fragile. And the cracks that formed back then, they never fully healed. Let's rewind. Banks, at their core, do one simple thing. They take your money and lend it to someone else, hoping that loan earns more than they pay you in interest. That's normal. That's safe. Usually. Now imagine banks start making riskier bets. Risky loans like mortgages to people who can't realistically pay them back. These are called subprime mortgages. In theory, the bank hedges itself by selling these mortgages to investors as bundles called mortgage-backed securities. Here's where it starts to get weird. These bundles were sliced, diced, and repackaged into new financial products called collateralized debt obligations. CDOs for short. Banks sold CDOs to each other and to investors, promising returns based on the mortgage payments. Sounds normal? Maybe. But here's the kicker. Most of the people investing in these CDOs didn't even know half the underlying mortgages were ticking time bombs. Some of these loans were frankly garbage, yet they were rated AAA, the safest rating possible. The system had created a giant invisible tower of debt, one that looked solid until it didn't. Numbers time, but don't worry, it's horrifying in a way you can feel. By 2007, Americans owed over $8 trillion in mortgages. About 20% of these were subprime. That's $1.6 trillion in loans likely to default. Banks weren't just exposed to a few bad loans, they were leveraged up to 30 times. Meaning, for every $1 of real money, they were betting $30. Lehman Brothers, $600 billion in assets. Half of them were tied to these risky mortgage bets. When defaults started, their balance sheet went from fine to insolvent almost overnight. And here's the part most people miss. It wasn't just Lehman. When Lehman fell, the system froze. Banks stopped lending to each other. Money markets, normally the heart of liquidity, stopped pumping. Globally, trillions of dollars vanished, at least on paper. Before the crash, headlines screamed about endless growth, housing as a sure thing, and financial innovation as a miracle. The reality? Much of the innovation was just smoke and mirrors. There was a surreal irony here. The people who designed these products didn't expect them to fail. The regulators trusted the ratings agencies. The ratings agencies trusted the banks. Everyone was betting that housing prices would always go up. It's almost absurd, and yet that's how financial crises happen. Everyone assumes the world is safe, until the math proves otherwise. Once Lehman collapsed, the dominoes fell fast. AG, the insurance giant, had guaranteed billions in CDOs. Suddenly it was insolvent. Money market funds broke the buck, forcing companies to scramble for cash. Governments around the world rushed in with emergency interventions, bailouts, interest rate cuts, trillions in liquidity injections. The irony, the very mechanisms designed to spread risk, derivatives, CDOs, global finance, amplified the collapse. The more connected the system became, the faster it unraveled. By October 2008, the stock market had lost nearly half its value from its 2007 peak. Unemployment would soar, retirement accounts would tank, and ordinary people who never touched a derivative felt the consequences first and hardest. Here's the uncomfortable truth. The 2008 crisis didn't end with Lehman. It reshaped global policy, yes, but it also left a blueprint for the next collapse. The same high leverage, the same risk mispricing, the same assumption that housing always goes up still exist in other forms today. It also changed how we view trust. Trust in banks, trust in ratings agencies, trust in the invisible hand of the market. That trust is fragile, and when it cracks, the effects aren't theoretical. They're immediate and brutal. So here's the question the world still hasn't answered. We know the math, we know the mechanisms, we've seen what happens when trust fails, and yet the system still runs on the same assumptions. Next time, will we be lucky, or is another collapse just a question of when? Because the real story of 2008 isn't just about Lehman, or mortgages, or Wall Street. It's about a global system teetering on invisible calculations, and the quiet fact that maybe it only takes one misstep to topple it all.